Make smart investment choices with your rental income. Now, here's how. So if you want to be looking at how to make better choices on how you derive rental income from the different ways available, keep watching, because that's what we're going to be talking about this week. Hi, Kevin Wright back here with another property finance video, and if you've watched any of my videos before, you know that I've spent years in property finance brokering, everything from a simple buy-to-let mortgage right up to multi-million pound development loans and everything in between. So I get asked a lot of questions, so I'm going to deal with another question that I've been asked, and I'm going to share with you how I answered it this week. And they said to me, we're in the process of purchasing a property that we're going to use as a furnished holiday let. In fact, it's already being rented out on Airbnb. Now, she said, we're going to be purchasing it in joint names, but my husband's income is already just tipping into the top bracket 40% tax rate. Now, she's been told that she would need a deed of trust to say the income from the property was 100% in her name and 0% in her husband's name. However, she's looked at government websites and the impression is a deed of trust is not for holiday lets, it's only for standard AST rental income. And for a furnished holiday let, we can just decide ourselves. And for a furnished holiday let, we can just decide for ourselves how we divvy up the income. Now, the question to me was, am I reading this wrong? Well, hey, let's find out. And the answer is going to lie in using the lesser known of two ways of buying a property jointly. What? You mean there are two ways of buying a property jointly? Well, there are, and there always have been. Now, pretty much everyone, when they buy jointly in their personal names, uses the joint tenancy options, the default option. And what that means is you each collectively own 100% of the property. But there's another, much less well known, and sometimes but very interesting way of setting up buying a property jointly, and that's tenants in common. Now, if you're well versed in property, you probably know about tenants in common, but let's work on the basis you don't, and let me explain how tenants in common work. Before I do that, let's examine how just the normal run-of-the-mill joint tenancy would work in this case. Now, HMRC are going to assume any income derived from a joint tenancy is split 50-50. And with this couple, that's more likely going to breach the husband's 40% tax bracket, so he's going to lose 40% profit. Now, of course, that's just on his 50% share. But could tenants in common work any better? Now, here's the big difference with tenants in common. As a couple, you get to nominate who owns what percentage. Now, in the case of one higher tax earner and one lower tax earner, you can attribute a disproportionate ownership of the asset. So it doesn't have to be 50-50. I mean, there'd be no point in doing it if you were going to do 50-50. But it can be 60-40, 70-30, 80-20, 90-10, even 99-1, and all in favour of the lower taxpayer. So the lower taxpayer would be deemed to own the majority of the property. And if they own the majority of the property, the equivalent percentage of those profits, now of course, they would go to them and not to the higher rate or on the cusp of higher rate taxpayer, as it is in this case. So to be clear, the advantage here is you can manipulate the percentage of ownership of a property or properties to maximise the benefit to the lower earner and minimise the benefit to the higher earner. So just working out how much below the threshold of the 40% tax rate the higher earner is and adjusting the ownership percentage on the tenancy in common basis so that it kept just below that would be a tax efficient way of dividing the rental income profits. Now, the caveat here is, hey, I'm not an accountant, but this is something that accountants have told me, so this is general knowledge, not tax advice. As always, if I'm touching on anything to do with tax, my clear and firm guidance is to run anything past an accountant, even better, a property savvy accountant that's got a few properties of their own. So there we are. That's my video for this week. Short and simple one this week. And hey, I'll be back next week with another property finance video. I'll see you then. If you enjoyed watching this video, did you know every Monday morning at 8:30, I do a live Facebook Q&A. So if you want to start the week with checking out some answers to your property finance questions, click the link here.